Okay, great. So I'll get it right for the radio. Is this it?
That's our card, yeah.
Yeah. Let me just make sure.
That's his. I didn't bring mine.
No, that's fine. Hey, good evening, everyone. This is Robert with the world-renowned Mr. Texas Real Estate. This is the Texas Real Estate Mastermind Hour. Hey, I'm joined here today with folks from RMH. These guys are CPAs and advisors. They're actually tenants in our building. They don't fit all their employees here, but they have a satellite office here. And we have been working with them at other events, and these guys are super knowledgeable. So we're so very excited to get them on the radio and share some insight with you guys. So why don't you introduce yourselves?
Sure. My name is Mike Huett. I'm a CPA. I've been with RMH for 15 years. Been serving clients in real estate and other diverse industries, but my specialty is absolutely real estate, and happy to take on new clients and help as many people as we can.
Great. My name's Randy Reimer. I'm one of the founding partners of RMH. We have about a 35-person CPA firm
Nice.
here in Houston, Texas, and we serve lots and lots of clients of all sizes, lots of entrepreneurs, but a great deal of our work is focused on the real estate side. So we love working with builders, developers, brokers, you name it. We've got people in just about every facet of real estate.
Excellent. Let's start with the first plug. So how do they get in touch with you if they want to become your client?
Reach out via email. My email is mhuett, so MHUETT @rmh.cpa. Also, you can call our main line, which is 713-590-3000.
Right. And my email is rreimer, so RREIMER @rmh.cpa. A little bit of a different ending to the email address. It's a special CPA
fancy
domain name, kind of cool. You got to pay extra for that, of course.
I'm sure you do.
But yeah, this rmh.cpa stands for Reimer McGuinness Hess.
Excellent. So you're one of the principal founders, right?
I am.
Give me a little history on the firm.
Sure. Our practice was started in 2006 by myself and Tom McGuinness. We came out of another firm here in town and brought 2 people with us. So we began with 4 people way back then. We're in our 16th, 17th year now. And we've just had dramatic growth over the years. We just continue to hire great people. Mike's a great example. Mike came to us literally as an intern in college.
Nice.
Has never been anywhere else and became a partner, I guess, 3 years ago.
Never had another real job.
That's right. He's never done anything else. But our firm is filled with people that have been at the big firms, the big 4s and the big 8s back in the day.
Sure.
So a lot of experience, lots of senior people. But we have a great young group as well coming into the firm. But yeah, we have a kind of really multiple niches. Real estate's one of our big ones. Healthcare is another one. And we have just a lot of true entrepreneurs. You know, those guys who were an engineer or a plumber or whatever they may have been working for someone else and said, hey, I can do this better myself.
Yeah.
And they went out and started their own company. And so we have a lot of those guys who started literally in their garage and have grown businesses. And our firm has sort of grown with them. So as they added another employee or a partner, and we help all the way along the way. So we help them, how do you structure that entity? How do you bring on a partner? How do you pay them? How do you handle the profits? All those sorts of things. So we do like to be more proactive as opposed to just that CPA who just does your return and you see them once a year. We like to visit with our clients, all the time. Gotcha. And really kind of want them to be the first person they call when there's something financial or tax driven that we get that phone call. So that's kind of been that's what's helped us grow over the years.
All right, let's go on a little tangent here. So let's go all the way back to 2005. By 2005, you're probably thinking about striking out on your own. 2006 happens. Now, 16 years later, is it everything you thought it was going to be? Is it more?
I would say it's more.
Yeah.
We never dreamed we would get this big. Just never in a million years thought we'd grow to this size. So I would say it's been everything we wanted it to be.
So 2008, 2009, we're having rough times in the economy, right? So your new firm, talk to me about just getting through these ups and downs, because your business is really tied to the economy. Like businesses will just drop off if it's a bad year,
That
right?
is true. It is definitely tied to the economy. However, regardless of good year, bad year, you have to file a tax return. If you have payroll, you've got to have payroll. If you need accounting work done, you still have to do those basic things. And we did have some clients that that bit the dust back then, but really not many. Most of our clients weathered that storm.
Yeah.
And some of those that weathered it came out very strong.
Yeah, if you could, same thing in real estate.
Exactly. Yeah, it was very much the same thing in real estate. So for the most part, we're somewhat inflation recession proof to some degree. And again, when you have a firm where you've got people that are trying to be proactive and help you through that, because we found, for example, with COVID, it was a great example for us. Everybody was closed, everybody was shut down. Well, they needed our help more than ever.
Right.
We were doing PPP loans, and
now
we're doing employee retention credit stuff. So we really got to shine, so to speak, in a really bad time for a lot of our clients.
Excellent. Well, that's great. Let's give them the contact information again. So
sure. Randy Reimer, RMH, Reimer McGuinness Hess is our firm name. My email is rreimer@rmh.cpa, and our main phone line is 713-590-3000.
Excellent. All right, so 2023, we're going to be doing our 2022 taxes. Everything looks like it's pretty normal this year.
So far, so good.
So far, yeah.
So far, we got deadlines, which is what we all aim for in our industry. We like April 15th being April 15th.
Yep.
So we think everything is on track, but like any other year, there could always be hurricanes or floods.
Sure,
or you name it. And so we're hoping to have a normal year, whatever that means after the last few years. But yeah, so far so good there.
So for those that are on fixed incomes, and I know you probably aren't doing a lot of this stuff, but Social Security has increased, right? So that's going to be also more taxes they have to pay on that, correct?
Potentially, depending on their situation.
Yep.
Yeah, it's very possible.
Anything that these folks should be aware of that's coming up in 2023 and future looking that we want to be aware of as entrepreneurs, real estate owners?
I mean, if you have a company and you're paying payroll, W-2 payroll to your employees, if you haven't taken advantage of the employer retention tax credit, you should absolutely be looking into that.
Let's go into it. What is that?
Randy, you want to speak to that a little bit?
Sure, I'd be happy to. The employer retention credit is a credit that you can get based on two different things. One is that your revenues went down during COVID. It's a measurement from 19, 20, and 21.
Gotcha.
There's a lot of talk on the radio about it. You may have heard some ads. But basically what it means is that if you qualify, then you can actually get a credit back. I mean, the IRS will send you money that it is taxable money back to you, but it's in a sense free money. It's money you've already paid, and it's up to roughly $25,000-ish per person per quarter, or per year. So it's a great benefit. We have a lot of our clients that have received some very large credits from the IRS. And so one of the things that's tricky about it is most people believe that you only qualify if your revenue went down. But there's another way to qualify, and that is if your business was negatively impacted or closed during COVID, which most businesses were.
Or you have supply chain issues.
Right. If you couldn't get lumber, you couldn't. You were stopped from going to the courthaus, or title companies were closed. All these different things.
Check.
So a lot of clients who initially didn't think they qualified, because even though they may have had a rough time, their revenue did not drop significantly, because for 1 year it needed to go down 20%, and the next year 25%. So some had 10, 15% revenue drops, but not the big drop. So we've found a lot of our clients do qualify, even though their revenue did not go down to qualify that way. So it's something everybody should be looking into. We're actually doing more of them now than when the ERC first came out, which was during 2021.
Wow.
Yeah.
Hey, let's give them that contact information one more time.
M. Huett so MHUETT at rmh.cpa. That's Mike Hewitt's email. And then our main line is 713-590-3000.
Excellent. Hey, guys, this is Robert with Mr. Texas Real Estate. Hang tight. We're going to come back from this break, and we're going to continue on the exciting tax discussion.
Very exciting.
We're going to go right into it.
Sure.
Hey guys, welcome back. Robert here with the world famous Mr. Texas Real Estate. By the way, that's a joke. We got one guy in Egypt who always watches us, and we got two people in Ireland, and they're usually in the energy business, so they follow us because they live in Houston. Right. And so we started calling ourselves world renowned, world famous.
International.
Yeah, international, absolutely. Sure. And this is the Texas Real Estate Mastermind Hour. All right, so the employer retention credit, that's very, very exciting. Of course, you need employees, right?
You need employees. You must have employees.
Right.
That is correct.
Not the solopreneur, right?
Right.
That's not going to work.
Not going
right?
to work.
Gotcha. Well, we're definitely going to want to investigate that because we do have. I mean, we check. One of the things we did with our investors, and we're proud to say we've never missed a note payment. We've protected everyone's principal in all our properties. Our properties are worth way more than we bought them for. So people's principals are protected. But cash flow has been rough for the last 2 years. And we have this sheet that we put out there, and we're like, hey, I want everyone to remember we went through COVID. Then you couldn't file an eviction. And then they officially closed down, right? And then the judge and the mayor said, don't pay rent. And then the orange man in the White House said, don't pay rent, right? And so then we went a whole year from that before we could enforce evictions. In the middle of that, we had the deepest freeze in 500 years here, which sucked hundreds of thousands of dollars out of our pockets, right? Because, for us, the insurance deductible was, because I own a construction company, I could get in and out. It didn't make sense for me to pull it, but hey, you got 40 of these, they start adding up at $5,000 a pop, right?
I remember hearing that something like 70% of people in Houston were negatively infected. Yeah.
So I went through that, and then the courts finally opened up, but they weren't taking. And then when finally the entire country said, go back to work and make money, nobody wanted to go back to work, and everything was super high, right? Mm-hmm. We talked about not finding paint, not finding 2x4s. So, yes, I'm now super excited because I'm going to be meeting with these guys in January to start going over how we could transition our work with these guys. So we're super excited, and we want you to be excited as well. I know where to find them, but you who are listening on the radio may not. So, Mike, give them the information one more time how to get in touch with you.
M. Huett, so MHUETT at rmh.cpa. Fantastic.
So you guys kind of know what we do around here, real estate, and you've been on a couple of our panels, and we've talked about different things. We're for us, our client probably looks a lot like your client. Their tech, our demographic is oil and gas guy, 55 and older, realizes his 401k isn't going to give him the lifestyle he wants. He's been told by you guys for years to get real estate because you could do depreciation, and he hasn't. Now he's freaked out, and he comes to us, and we find him 3, 4, 5, 10 properties in a year, and we get them going on that stuff. So to that, let's talk a little bit about the difference between cash and wealth, and I'll set the table again from our perspective. Cash flow is important as long as we're covering the PITIM, right? Principal, insurance, taxes, principal, interest, taxes, insurance, and management. Like, we're not having to put money in.
Right.
But after that, I'm more excited about appreciation and depreciation than I am necessarily about picking up another $150 or $200 a month per door. And so that stuff, if that is income and we're not smart about their write-offs, that's going to go right to their bottom line and get taxed at their federal rate, correct?
Right. 37% potentially.
Yeah.
Ordinary income.
Most of the guys who are in our mastermind are going to be at 37%. Absolutely. Yep. So, but creating and keeping wealth, I imagine that you guys have looked at that and have a lot of clients where you have set up some strategies. Hey, you're 55 now. What does it look like when you're 60? So you could talk about some of those, like what benefits of depreciation and holding on to wealth and some of the things that you talk to your clients about.
For sure. I mean, what's beautiful about rental real estate is you can be cash flow positive but still have a tax loss because of depreciation expense.
You can make money and lose money. Yep.
And you get automatic straight line depreciation even though the property's most likely going up in value. And so that makes real estate super tax efficient and makes it really just increases your ROI on any investment that you have. There's some other tricks to the trade there. I mean, there's something called a cost segregation study that some people are aware of and some people are not, but you can take a huge upfront depreciation expense in the first year whenever you buy a property. There's some limits and reasonableness to when you want to do that and when you don't, but that's a great option that you should definitely explore when you're buying new properties. And then, the appreciation side. So, you hold onto a property for however long and eventually sell it for much more than what you paid for it. You're looking at long-term capital gains,
Right.
but at worst case scenario, as opposed to ordinary income. Long-term capital gains taxed at maybe 15%, maybe 20%, but not at the 37%.
Sure.
And there's options around that as well. With 1031 exchanges, you
Absolutely.
can continue rolling that tax liability potentially forward indefinitely. As long as you're willing to reinvest it in real estate, then you don't have to pay any tax.
So I'm gonna stop right here and do a disclaimer that you're not giving tax advice, that you're just talking to me in a general conversation, but we're gonna go real deep into 1031 right now.
Oh, great.
All right, so 1031, if I have a property, and do I have to basically pay back my depreciation on a property that I'm putting into a 1031 exchange?
No.
So you can carry that forward into
Yes.
the next property.
That's right.
So that's why I call 1031s welfare for the rich. Because they don't have to make that payment at closing, right? You can just roll it right into the next one and keep that whole thing going. And
One of the best kept secrets, I think, in the tax world is
Yeah,
with real estate.
hit us.
Well, is that 1031 exchange.
Yeah.
But you literally could roll that 1031 multiple times, and then at some point, if you hold it until you die.
Yes.
Again, this is maybe a little bit morbid, but if you hold it till you die, the current rules allow you to step that basis up to fair market value as of date of death. You sell it for that price, you never pay tax on that gain that may go back 20, 30 years. It's pretty incredible to
do
think
it
that that's
multiple
even
times.
possible.
Yes.
Multiple properties.
Yes.
Turn yourself into a nonprofit.
Exactly right. And this is again so we have the conversation with, the guy who's just kind of new to real estate, and he's like, but I need the cash flow. I'm like, no, don't worry about that. Look at this part of the spectrum. We're going to be appreciating. We're going to take depreciation, and then when we want to trade up or trade in, man, we can roll this stuff over, right? So,
Exactly. No, it's great. It's an incredible tax benefit. It's been under scrutiny for years in Congress. It gets kicked around quite often that they're going to eliminate it or curtail it, but it's not happened yet. So it's still a great tax break that's available. And I think Congress has no idea the level of transactions that are generated because of 1031
Right.
exchanges.
and the inflation in the marketplace,
Oh, absolutely,
right?
absolutely.
Because you just want to exit. You're not looking for a deal. You just don't want to have that
pay
capital.
tax.
That's right.
That's exactly right.
Well, here's the thing we talk about all the time is I know we're in Texas, so we all can't stand Nancy, but her husband is a real estate developer.
Oh, yeah.
Like the 1031's never going away while she's around, right? It's
Could
just
be.
not
You're probably
happening.
right.
So
I'm sure he's in favor of it. I'm
of
sure.
course, and all the Democrat guys hold real estate. They don't want this stuff to go away, right?
I think all the
Absolutely.
politicians do.
Yes, of course.
They all take advantage of
Yeah,
it.
of course.
As they should.
As they
It's in the
should.
code.
That's right.
And Nancy's never going away.
No, you're right. Well, she raises too much money for Republicans, so we can't let her go, right? That's true. I'm sure you've heard this said a bunch of different ways, and I don't know who the exact quote is, but I'll wrap up this segment saying that my personal philosophy is, as a citizen of this country, it's the greatest country ever and ever for like the history of ever.
Amen.
I am responsible to pay the exact amount of taxes that the government says, and not one penny more.
Amen.
Absolutely right.
So I pay my taxes, and anything, any legal loophole I have, I'm going to take advantage, and I've got to come to guys like you. Give us the phone number one more time. We got to head into this break here.
713-590-3000.
Excellent, guys. I'm telling you to reach out to them. Get your 2022 filed with these guys. Get your future rolling with these guys. They're right here at the Texas Investments Real Estate Investment Center. We'd love to see you out here. All right, hang tight. We're going to come back from this break.
Yep. Cool. We just did a cost seg for one of our real estate groups. Did you do one here?
Yeah,
We did it. We got them to do it on this building.
Good.
Yeah.
We just had one of our guys that I want to say they paid $3.5 million for the building, and we got almost $2 million of it
Wow.
deducted.
That's
in the first
amazing.
year.
Yeah, it just depends. If you have anything like specialty, like you have like a loading dock with.
Hey, let's hold on. We're going to go right into the show here. Let's talk about cost segs.
Yeah, I think we should.
Yeah, absolutely. Hey, guys, welcome back. This is Robert with the world-renowned Mr. Texas Real Estate. This is the Texas Real Estate Mastermind Hour. And during the break here, we started talking about cost segs. And I know people get a little, it becomes a little overwhelming because technically we need an engineer and we need an accountant. And, that's probably the most boring dinner talk you're going to have. No offense, guys, right? But when you get these guys together and they start understanding the tax code, boy, you can stand to have a big win. So who wants to?
Absolutely. I'll talk about it.
Sure.
So cost segregation studies are pretty unique. When you go buy a large building of any kind that you're going to rent, the IRS code allows you to look at all the components of that building.
Yep.
So let's just pretend you paid $2 million for the building, but when you take that building and begin to dissect it and separate the parts, you've got an air conditioning system, you've got a parking lot with lights, you've got signage, you have all these different components of the building, and that the whole term segregation means you segregate all the cost of that building. And with the current IRS depreciation rules, anything that is 15-year property or less is allowed bonus depreciation, meaning immediate write-off. And I was just telling the story a minute ago during the break that we have a real estate group here in Houston, and we just completed a cost segregation study for them. Is about a $3.5 million building, and almost $2 million of that purchase was deducted in 2021.
That's exciting.
And you can imagine the impact. They had a lot of income. They were fully able to offset other income with that $1.6 million this year. Yeah. So it's just an incredible advantage you need to be checking into. And the cost of it is really peanuts compared to the benefit. It is.
Yeah, it really is.
It's nothing. And it's gotten to where now there are a lot of folks that do that work, that do cost seg studies. So you could even shop it and find somebody who'll do it for a reasonable price.
I think we spent $6,000 to $8,000 here and picked up $500,000.
Yeah, exactly.
Amongst four partners, we're like, I'll spend $2,000 to get $125
all day
any
long.
day of the week.
That's good.
Can I do it again? Can I do it next year?
And the engineering company that did it is like many, that they'll tell you exactly what they think the tax savings is going to be.
Yeah, before they start.
So before you ever pay a dime to them, they'll tell you, this is what we think it's going to save you. And your CPA or you probably can do the math on that and say, hey, this makes sense or it doesn't. And if it doesn't make sense, then just don't do it. But you should definitely kick the tires on that and definitely take a look at it just to see if it's a good fit.
And now this is for retrofits, or is it also for new construction?
Both. Retro and new.
No, that's really, really important. And we're building out a little warehouse because we're about to get into a different business in the construction world. I don't want to say what right now, but like receiving docks and all that stuff. That's awesome.
Yeah, if anything that's specialty, like a receiving dock where you have really thick concrete, any kind of specialty asset like that, you're going to get way more bang for your buck. You get a much bigger deduction for that. Like medical clinics, where they have so much electrical ran to each room. I mean,
hospitals do well.
You go beyond one light and one plug in a room. It's all extra deduction for you. So it really makes a difference.
It does.
And then you were talking about bonus depreciation. So I always remind people, is like, if love him or hate him, Donald Trump was, at the core of his existence, a real estate developer.
Absolutely.
And we had a real estate developer as president, and you probably, if you owned real estate, you made out, right?
Absolutely.
So he did some bonus depreciation as well, right?
Oh, absolutely. No doubt about it. But bonus depreciation does begin to reduce going into 23.
Gotcha.
It's going from 100% that it's been since 16.
Yep.
It's going to go to 80% next year and go down 20% a year until 2025. That said, there is still a Section 179 deduction.
Oh, it's our favorite.
So that's up to $2 million.
Randy, I teach Section 179A is your best friend.
It is a good friend. That's right.
Right?
Absolutely. Yeah.
And that's 100% for, that's laptops are included in there.
Absolutely.
Like anything.
All your equipment.
Oh.
You bet. Anything and everything.
Here's how I say it, and you feel free to use this. There's two tax codes in this country, one for workers and one for businesses. Which one do you think is better?
Businesses.
So why don't you own a business?
Yep.
Yeah.
Couldn't agree more. We have a lot of clients that we do 1040 work for that are very successful, but they're wage earners.
Yes.
And at some level, there's limited tax saving opportunities for the wage earner. But you flip that to a business, the possibilities are unlimited. We have an attorney client, for example. He's had a really great year, and that the courts are back open, so he's had a really good year. We're doing. He has his own small firm, he and his wife, and we just showed them how they can put away about $500,000 into a retirement plan. Nice. But he couldn't have done that as an employee, which he once was an employee. And so there are just so many things you can do. We've talked before about paying your kids You know,
Yeah.
that's a great little tax benefit. If you got kids, especially if you really want them to do something in your business. Maybe it's file, maybe it's shred, maybe it's take out the trash. I mean, we've got clients with kids.
We have 2
8,
kids that
10,
work here like
15
every
years
weekend.
old.
Yeah,
You bet.
absolutely.
You bet. I mean, it's a great way to shift the income out of your tax bracket to their tax bracket. And what we tell our clients is, hey, take advantage of that and put about $6,000 into a Roth IRA for that 10-year-old kid. Do that for 5 or 6 years. By the time they're 40, 50 years old, they're going to have
They're done, yeah.
6 figures or more in that account. So
All tax-free.
All tax-free. Exactly right.
I guess how familiar are you guys with cash balance accounts?
Familiar, very familiar.
So that's probably how that attorney.
That's it. It's a defined benefit plan, and it is a cash balance plan.
So in our world, because we hold on to apartments for a while, and then all of a sudden we sell it, and we're like, we've maxed out everything.
Right.
We move on to a cash balance, and it's just really a fancy way of saying a private pension.
That's right. That's right. Yeah. Yeah. In the pension world, you've got like a 401k is a defined contribution where you're putting money in. A defined benefit plan or a cash balance plan is driven by your age. So the older you are and the closer you are to retirement, that actuarial calculation gets done once a year, and it gets big. It gets real big.
And so the benefit of that is being able to put it to a retirement fund without having to pay income taxes on it.
You reduce your income in that year.
And I'm 55, so I think my number's like 242 or something, like $242,000. So I sell an apartment. We have a windfall. What do we do with it? I'm not going to pay taxes on it. I'm going to go and do this.
Absolutely.
Yeah.
Great
and
benefit.
From that cash balance account, we can go buy more real estate or whatever, right?
Just,
Exactly right.
Invest inside of there.
You're absolutely right.
Yeah, so listen, there's only a few Zuckerbergs and Elon Musks and guys out there who are going to go create these billion-dollar companies, right?
Absolutely.
But anyone can buy real estate.
Yep.
Right? And then anyone can start taking advantage of all the tax code that favors. Listen, the government got out of the housing business 40, 50 years ago. They can't build houses. They can't run them. They know it was a massive failure. So instead they said, you, the entrepreneur, go build them and rent those properties, and we'll support you however we can support you.
Exactly.
And so trust me, the government needs us to provide rental properties.
Absolutely.
Right? And this city needs it, and we're in Corpus Christi. They desperately need it. They need us to go out, renovate these homes, and provide rental properties. So along the way, we get to take advantage of the things that the government says, let's motivate these entrepreneurs to do that. And again, we're going to take advantage of it. I've been told by my accountant that with that cost seg and another cost seg, and if I just do the cash balance stuff, I'll never have to pay federal income taxes again.
It's a pretty good deal.
Yeah, I mean, we own millions and millions of dollars just in depreciation alone, and I'm sure when you started your business, we weren't looking to take a lot of money out. You kept reinvesting. So
you bet.
Yeah.
I mean, if you could 1031 one of those properties that you cost seg, then you don't have to worry about even making that contribution. Just roll it right into the next one.
Yep.
But you got to get all your partners to agree.
That's the whole thing. Yeah. So listen, guys, you guys have a wealth of knowledge, and I want people to call you guys and email you guys and get your information. So go ahead and give them the emails again and give them the phone numbers.
Sure. Randy Reimer. My email is rreimer, RREIMER, at rmh.cpa, and our phone number is 713-590-3000.
My email is mhuett, MHUETT, at rmh.cpa.
Excellent. Guys, hang tight. Robert again here with the world-renowned Mr. Texas Real Estate. We'll be back from the break. Go. Yep. Hey guys, welcome back. This is Robert with the world-renowned Mr. Texas Real Estate. This is the Texas Real Estate Mastermind Hour. We appreciate you guys listening to us every night. We're with our friends here from RMH. Make sure that you guys are reaching out to them. We've had really good conversations. If you haven't been joining us for the last 3 segments, absolutely go find us on YouTube. Just go to the Texas Real Estate. What is it? What's our YouTube channel? Yeah, Texas Real Estate Network. Yeah. Go check Texas Real Estate Radio Network. We're so in transition with our marketing. Texas Real Estate Radio Network. Go ahead and hit that up. And then what you need to do is just look for this one. It's going to be under RMH, and make sure that you absolutely listen to this because the stuff here is fantastic and worth your 45 minutes. Let's keep going on this stuff. So let's just go back to as an entrepreneur, right? So running a business versus the regular income, right? So I've been told a lot of things like, hey, unless you're making like $35,000, $40,000 from your LLC, don't worry about it because it's really just a pass-through. I know a little bit more, but that's okay. So, but at what dollar figure are you guys recommending, hey, it's time to really set up a small business versus constantly doing this in your name?
I mean, there's no income limitation just to have a single member LLC, just to have an LLC and have a little bit of legal protection for you. That's always a good idea. The only time I look at like an income threshold is like when you might consider converting that LLC to an S corp if you have earned active income, like if you're flipping houses, and you're running a business, as opposed to I don't usually recommend an S corp for a rental property, but if you're earning somewhere over $60,000, $70,000, $80,000 annually inside your LLC for earned income, I'd recommend maybe consider it an S corp, but there's really no limitation for having an LLC set up. That's always a good idea. You might grow from there and might start small, but it's always a good idea to run your business inside a business entity.
Yeah, absolutely. From a legal liability standpoint, I mean, in my opinion, I tend to be in favor of more entities versus less entities.
Me too. Up top, Randy. That's what I want. Yes.
Yeah, I mean, it's just if you're renting a piece of property to someone, you definitely want that in some sort of an LLC or some form of an entity. You've got to insulate yourself personally, especially if you've got a nice W-2 job over here, you're working, and you have a home and some other assets. Last thing you want is a slip and fall in your rental property. That's where they can come after you personally. So that LLC definitely gives you some protection there. So we always suggest that. But yeah, as you grow, there's all kinds of opportunities. Y'all probably have talked about serial LLCs, or
so
some people love those, some people don't, but that's a great tool.
I'll tell you two things. I'll tell you what I do first of all. My personal rule is no more than 3 assets or a total of $1 million in assets in any one LLC.
There you go.
The serial we've done. The problem is we're trying to get loans on everything.
Right.
So the underwriters don't like it.
Right.
Really?
Yeah. So we don't do them anymore. We just don't do them because it just becomes so difficult. Because you could really just manipulate the ownership at a drop of the hat there, right? Nobody really knows it's tied to this thing. So they want it in a very sort of single-purpose
entity.
Yep. Yeah. The second thing I tell them about folks about LLCs is go get one as soon as you start a business, because typically any major bank will offer you a credit card in that business name.
True.
That does not reflect on your FICO score. So now you can start using that credit to grow your business without necessarily worrying about it affecting you personally financially. Yeah. So that's the two things there. Let's go back to 179A. I love it, right? So explain what that is for folks.
I mean, if you buy an asset for your business and you wouldn't otherwise have the ability to 100% deduct that in that first year, you can take 179 in most situations to get that deduction all in the first year.
So office furniture?
Yeah, absolutely.
Office furniture.
Computers,
printers,
copiers,
printers, yeah.
Furniture, all that.
It's available for vehicles as well.
Yes.
And really the beauty of that is if you're working with a good tax professional, you can pick the exact number that you want to deduct and not more than that. So if you're at a very low tax bracket, maybe you don't want to take that deduction at the 10% tax rate. You're like, hey, I'm going to have more income next year. Let's go ahead and pay a little bit of taxable income at a lower level. Right. But let's save this deduction for future years because I think the future looks bright.
Right. And the beauty of that, too, is just is that it doesn't mean you have to pay cash. Right? We have a lot of clients that go out on December 30th, December 31st and purchase all that and put it on a credit card or have a bank note or a line of credit, get the full benefit of that deduction, pay it off over the next 5 years or whatever time it takes. So that is a nice little tool there that you get the benefit of that deduction even though you haven't spent a penny of cash.
Talk to them about the heavy-duty trucks. Is it over 6,000 pounds? That's
what are those thresholds for
6,000 pounds.
6,000?
Yeah.
6,000 pounds.
Yeah, you can take bonus depreciation on that. If you got to look at business versus personal use. That's always like an issue based on mileage and track your mileage. But yeah, you can take huge deductions for those in the first year if you want to.
Yeah.
And we have to remind everyone that you actually have to make money to get all these deductions, right?
They don't benefit you at all
if you're not making money,
making
right?
money.
You got to actually make money. So on that truck thing, that's for us. We're getting Cybertrucks next year, so we know that there'll be 100% write off on that.
Nice.
You bet.
Nice.
You bet.
And we won't use it for anything other than work.
Right.
Great. Anything else that the entrepreneurs should know about? How about do you recommend them taking the home office write down, or is that just can get a little tricky?
It can get tricky. We've had very little issues with it in terms of clients that take the deduction. We've had
I've
no
been told
audits
to
that
just
I
be
can recall.
reasonable, right?
Yeah. I have the old hogs pigs theory. You've probably heard that.
Yes,
Hogs get slaughtered,
Right.
pigs get fat, and hogs get slaughtered.
Yeah.
So we generally don't want you going crazy with it. But if it's legit, we've got I have a client who's a physical therapist and actually uses her garage and areas of her home for her classes and Pilates studio and things like
Great.
that. So we take a big deduction for her, but it's real. You walk in that place, it's real obvious it's being used. Whereas most people have got a study or a bedroom or an area that they're using, and for a lot of folks, it's not a lot of money. It may be $1,000, it may be $2,000. It's not chicken feed, but you just may want to weigh the benefits of it.
Well, the reason I bring all this stuff up is because I once read an article, I think it was in Forbes, and they said that 65% of Americans overpay on taxes.
Yeah,
And it's
true.
It's not because they're just willy-nilly writing extra checks. It's because they're not aware of all the deductions that they're allowed.
Very true.
And that's why they need guys like you to say, hey, you're own a couple properties. Do we know about this? And hey, did you buy a commercial property? Did you do a cost seg? It's not too late. Let's go back and figure all this stuff out. So
I mean, the tax code is so complicated, and it
Oh,
changes
God, yeah.
every year, at
Of course
least
it
every
does.
4 years, that it'd be impossible for the average person to keep up with all the tax laws.
Right.
I mean, it's just,
Right, and there's still some fear out there. There are people. We have some folks that every year say, "Oh, I don't want to write that off," and it's like, no, you can write it off, and you should write it off. Why would you not write it off? And so I don't know what it is. There's some folks that are just so conservative, they don't want to get any trouble with the IRS, so they won't take some deductions that are totally legitimate. So yeah, we're just, as you mentioned, we're all about taking every possible deduction you can take. And at least letting our clients know what every possible deduction
For sure.
may be. It's like
Absolutely.
they may decide not to, but we're going to recommend that you pay the government as little as you possibly have to.
yeah, and it's not just home office. I mean, there's some other related deductions that people forget about all the time. Like everybody has a cell phone, and good luck doing any job or any service without having a cell phone.
right.
And they're not cheap, and so you can deduct a portion of your cell phone. You can deduct mileage on your personal vehicle that you use for business.
Yeah.
You can deduct, a portion of your home internet services. I mean, there's a lot of things that people forget about that they would maybe not actually have in their business books or their business records or pay from their business account, but they're absolutely deductible regardless.
Excellent. Guys, you've got to reach out to them. Go ahead and give them the contact information one more time.
Sure. Randy Reimer. My email is rreimer, RREIMER, @rmh.cpa, and our phone number is 713-590-3000.
Mike Huett, and the email is mhuett, so MHUETT @rmh.cpa, and the phone number is 713-590-3000.
Well, I got to tell you, this has been very exciting. I geek out on this stuff. I really, really love it. I tell you, like 179A is your best friend, right? So thanks, guys, coming in. We
You're very
appreciate
welcome.
it.
Thank you.
Guys, have a great night. Make sure you check out the full podcast out there. You're going to want to listen to this. Thanks.
All right. Thank you.